Hey there. So if you've gotten to a point where you feel like just buying and holding stocks isn't quite cutting it, that there has to be more to it, then you are absolutely in the right place. Today, we're going to open up a part of the market that, let's be honest, kind of scares a lot of investors. Options. I mean, really think about it. Is that all there is? For a lot of people, yeah, that's the whole game. But what if I told you there's a way to make money when stocks fall? Or, get this, even when they go absolutely nowhere? That's where the real power of options starts to show itself.
I like to think of it like this. You would never try to build a house with only a hammer, right? You need a whole toolkit. Well, in the world of investing, options are that advanced toolkit. They give you the perfect tool for pretty much any job, no matter what the market is doing.
Okay, before we get into the cool strategies, we have to understand the two most basic building blocks. First, you have a call option. This gives you the right, but not the obligation, to buy something at a set price. Then you have a put option, which is the opposite. It gives you the right to sell at a set price. A simple way I remember it is you call the stock over to you and you put it away from you. Seriously, these two simple ideas are the foundation for everything else we're about to cover.
So, first up, let's grab the defensive tools from our kit. Think of these as your shields. These are the strategies you use to protect your portfolio when the market starts looking a little stormy. Now, the official term you'll hear is hedging. It sounds complicated, but really it's just a fancy word for financial insurance. You pay a small price up front, your premium, to protect yourself from a potentially huge loss down the line. It is a total cornerstone of smart risk management. All right, let's look at a classic, the covered call. Let's say you own 100 shares of some stock, and you think its price is just going to tread water for a while. With a covered call, you can essentially rent out those shares to someone else. You sell a call option, and for doing that, you get paid a premium right away. It's a pretty neat trick. And this right here is the real magic of it. You get paid while you wait, and you actually lower your risk at the same time. As the source material points out so well, it's a strategy that can turn a stock that's just sitting there doing nothing into a real income-generating machine. Okay, here's another protective tool for you, the married put. And you know what? The name tells you everything you need to know. The very moment you buy the stock, you also buy a put option for it. You're marrying them together right from the start, creating one single position with a clearly defined risk. So as you can see, this whole thing acts like a safety net for your investment. It doesn't matter how far that stock might fall, you have a guaranteed price you can sell at. This is exactly how you can protect yourself from those wild, unexpected market events that can just decimate a portfolio. Okay, so we've seen how options can play defense, but what if you want to go on offense? What if you've got a really strong feeling about which way a stock is about to move? Well, that's where our next set of tools comes into play. All right, take a look at this table. We've got two classic strategies for betting on which way the market's headed. Over on the left, you've got the bull-call spread. You use that when you're feeling optimistic, when you think the price is going up. On the right, the bear-put spread is for when you're feeling pessimistic. But now look at that bottom row, the outcome. See how for both of them, your potential profit and your potential loss are limited? That makes these plays way less risky than just buying or shorting a stock.
So you might be thinking, wait, why not just buy a call or buy a put? And that's a great question. The answer, in one word, is cost. With the spread, you're taking the money you get from selling one option and using it to help pay for the one you're buying. It's a clever way to make your bet on direction for like a fraction of the price. Now we're getting into some of the really fascinating tools in the box. With these strategies, we don't really care which direction a stock moves. We only care about how much it moves. This is where you get to trade volatility itself. So picture this. A company is about to release its earnings report, or maybe there's a big FDA decision coming. You are absolutely certain the stock is about to make a massive move, but you have no earthly idea if it's going to be up or down. So how in the world do you trade that?
Well, the answer lies in these two strategies, the long straddle and the long strangle. Look, in both cases, you're buying a call and a put. That means you're set up to profit no matter which way the stock breaks. The only real difference is the strike price. That's the price you agree to buy or sell at. A straddle uses the same strike for both the call and the put, while a strangle uses different ones, which, as you can see, usually makes it a bit cheaper to put on.
But what about the flip side? What if you're convinced a stock is about to become as exciting as watching paint dry? Believe it or not, there's actually a way to profit from that exact kind of boredom. And this brings us to the Iron Condor. It's a huge favorite for traders who expect things to quiet down maybe after a big event is over. As you can see, it's actually made by combining the two spreads we talked about earlier. By doing this, you create this profit range. And here's the cool part, as long as the stock price stays inside that range when the options expire, you make your maximum gain. You are literally placing a bet on the stock doing almost nothing.
So we've pulled out tools for protection, tools for betting on direction, and tools for trading volatility. The big question now is, what do you do with all this? What's the right move from here?
If you take one thing away from all this, let it be this. There is no single best option strategy. Period. There's only the best strategy for you in this specific situation. It all boils down to knowing your own goals and having a really clear-eyed view of what you think the market is going to do.
You know what? I'm going to read this next part word for word from our source because it is just that critical. It says, options trading can be very risky, which is why it's meant for experienced investors. If you're a novice, consider using a demo account to test out your strategies. I really can't say that enough. These are incredibly powerful tools, but in the wrong hands, they can be dangerous. Please take your time, learn, practice in a demo account before you even think about putting real money on the line.
So, as we wrap this up, I just want to leave you with that one question. We've really only just scratched the surface today. The real journey, the fun part, begins when you start figuring out how these tools can fit into your own unique way of investing. Thanks so much for joining me today.